Okay, so welcome everyone. My name is Mandeep Burmi, and in this webinar I'm going to show you guys how you can master any currency pair. We will mainly look at British pound and US dollar. That's my favorite currency pair, but you can apply that same process to any currency pair in the Forex market. Okay, so just a quick disclaimer for you guys before we get going. This is for educational purpose only. Forex trading, it's a very risky business, so make sure you understand all the risk before you start trading your live account. About me, I'm a full-time Forex trader. I've been trading full-time since 2014 and part-time from 2010 until 2014. When I was trading part-time, I was also working as a driving instructor. And before driving school and my trading career, I was working as a product designer and as a design drafter. So my background is in mechanical engineering. So in this awesome webinar, you will learn how you can master any Forex currency pair to make consistent profit. We will mainly study the price behavior of British pound and US dollar during different sessions. We're going to look at Asian session, London open, London lunch, overlap session, London close, and New York close. So we will look at all the high probability trades, all the high probability price patterns during these sessions. And we will also look at British pound and US dollar. So here we have 6 steps to master any Forex currency pair. Now the process is, as I said, the process is still same. You can take the process, apply that to any other Forex currency pair. If you like to trade Euro and US dollar, or maybe US dollar and Swiss franc, it doesn't matter. You can apply that same process and you will make consistent profit. So let's go through all the steps. So we have step number 1, understand how price move throughout the day. So if you take a trading day and if you divide that into different sessions, so we have Asian session first and we have London open. Let me see if I can change the cursor. Okay. Yeah, so we have Asian session, we have London open, London lunch, overlap, London close, and New York close. So we will look at each step in detail and really refine your entry points, your price patterns, and everything. So step number 1, you want to understand the price movement throughout the day. And then how you do that? You do that by taking sample sizes. So you will start with a sample size of 100, then you increase that to 500, 1000, and then you go to the next step. Then you will find price patterns. So the data that you collect, then you're going to find price patterns and price similarities. And then you further refine your sample sizes to find very high probability trades. So from your sample sizes, from the data that you collect, then you're going to refine your data to see which one is a high probability trade and which one is a low probability trade. And then you will back test everything to confirm. Okay, and when you're doing that, what you're doing is you're internalizing the information. So when you take a sample size of 100, 500, you're going through that process, and when you're going through that process, you're actually internalizing the information. So you will see which one is a high probability trade and which one is a low probability trade. And after taking like at least 500 sample sizes, that's when you go live and you're going to start making money. Now let's look at each step in detail. So step number 1, understand how price move throughout the day. So let's say you take a full trading day. Doesn't matter if it's Monday, Friday, doesn't matter. So you take a full trading day and then you're going to divide that into different sessions. So this line here represents the start of the day, okay, and this line here represents the end of the day. So we have Asian session, which is from 2200 GMT to 500 GMT. Then we have London Open, 500 GMT to 10:30 GMT. And guys, these times are just like approximate times. Then we have London lunch. That's from 10:30 GMT to 1200 GMT. So during London lunch, that's when like all the big players in the market, they go out for lunch, and you will mostly see the price will actually start to slow down a little bit. So you're going to see a big difference between London Open session and London lunch session. So London lunch session is also my favorite session to trade, because that's when I know the market is not very volatile. So sometimes we see very high probability trades, and I will show you some of the examples as well. Then we have overlap session, which is from 1200 GMT to 1530 GMT. Overlap session is the most busiest session in the Forex market, because that's when London is still open. So that's when London is going, and at the same time around 1200 GMT, we will see the North American markets, they will open up. So we will see New York open up and London, so they both are trading at the same time. Then we have on London close, which is from 1530 GMT to 1700 GMT. That's my favorite time to trade this pair, because that's when you see very high probability trades. And then we finally have New York close session. Okay, yeah, so it doesn't matter. You can do this on any pair. If you're trading euro, doesn't matter, Swiss franc, just take a full trading day, divide that into different sessions, and then what you do is then you further divide. Let's say you want to study Asian session in detail. You want to know everything about Asian session. Then you're going to further divide that session. So here we just market example here. So we have a start of the day here, then we have Asian session first, then we have London Open, London lunch, overlap, London close, and New York close. So when you start to take sample sizes, even like after taking like 20 sample sizes for Asian session, you're going to notice the price movement during Asian sessions. Price is not very volatile. It's mostly it's range bound. It just stays like in a range of like 20 pips or 30 pips. And during London Open session, that's when we see very big movements. So in this example here around, so we have Asian session first, and the Asian session ends around 500 GMT. And guys, this is a 5-minute candle chart, British pound US dollar. It's from IC Markets. And so you will notice around 600 GMT, that's when we start to see price starts to move. So here we see in this example around 600 GMT, we see this huge price spikes, because that's when London is open, and we really start to see pretty big price movements. So price spikes up, it stalls for good like half an hour, and then price spikes down. Then we see price takes another leg down, and then we see very aggressive move to the upside. This one looks like it's a news-driven move. And then during London lunch, that's when all the big players in the market, they go out for lunch. And that's why we see, you can see here, there is a big difference in the price movement. London Open, very volatile session. And during London lunch, price is mostly moving sideways. And now during London lunch, if you notice, if there is a big spike to maybe trying to make new highs or new lows, chances are it's not going to break that high or low that was made in the London Open session. So that will be a very high probability trade. And I will show you some examples as well. So then we have overlap session. Overlap session is also very volatile session because that's when we have London market, and at the same time we got North American markets. The main difference here is if you look at London Open, we just have price spikes to one direction. So we got for 10 minutes price was just moving higher, then it stalls, then we see another pretty big price spike to the downside. Now look at overlap session. We see a lot of price movement in the overlap session, lots going on there. So we see price moves up, comes down, price moves up, comes down, up, down, up, down. So that's like lot of volatility there. There's lots going on. It's not as clean as London Open session. And then finally we have London close, my favorite time to trade this pair, British pound. London close is also very good if you're trading euro and US dollar, because that's when you see very high probability trade. So on this example here, see this spike here during London close, we see price spikes up to the intraday highs. So we have highest point here that was made in overlap session, which is also lining up with our London close session. Now during London Open session, so during London close, if you notice price is spiking higher, most likely it's not gonna make new highs or new lows during London close session, because that's pretty much the end of the day. So in this example, I would actually take a sell trade here. It's a very high probability setup. So we have a huge spike to the previous, to the London Open highs and overlap highs. So you take a sell trade here. You can put your stop loss maybe like 10 pips above the highs, and then you just wait for the price to retrace back to the base of the spike. And we will look that in detail, okay, just in the coming slides. Same thing on New York close. Price make another attempt to break the highs, and most likely it's not gonna break those highs, so you can actually take another trade here. So we see same thing here, price spikes up to the highs, and then we see price comes all the way down to the base of the spike. And here we actually see another attempt. These are very high probability trades. Anytime when price spikes up to a key level, so here we have a key level. Anytime when price spikes up to a key level, most likely it's not going to break that close and London close. Okay, it's a totally different story during London Open, because that's when we are just starting. There will be lots going on during London Open, so you have to be careful when you're trading London Open session. Okay, any questions so far? Okay. All right. So let's say you want to study Asian session in detail. Okay. Then what we do, we take a sample size of 100, 500, 1000. Then we're going to divide Asian session into different phases to really see what's going on, to really understand everything. So here when, now this slide is actually from 2012 when I was going through this process, and I still see same thing, patterns, they are repeating every day. So what I did, so I actually divided Asian session into 5 different phases. Phase number 1, Asian range. You just want to know, what the price action looks like during Asian session. Do we see a range-bound price action, or is it just going in one direction? So fractal means range-bound. Price goes up, goes down, price goes up, goes down. So that's a range-bound. One-wave movement, price is just kind of like drifting to one side. Maybe it's just moving higher, or maybe it's just moving lower. Or we just see both. One day it's range bound, next day we see one-way movement, next day it's range bound again. So we want to understand all that. So that should be your first one. then you just ask yourself, okay, what is the pip range? How much movement do we see? Does it move like 20 pips in Asian range? Does it move 30 pips, 40 pips? So you take like a sample size of 25, and that's going to give you pretty good idea of what price is doing during Asian session. Then you go to phase number 2. That this one is very important. So when you're doing phase number 2, when you're collecting data for phase number 2, what you're doing at the same time, you're still studying phase number 1. So we are still studying what all these points here as well. So phase number 2, you're just asking yourself, does it make new highs and lows? If yes, okay, then how? You know, is there a consolidation before it breaks previous day highs, or do we see price spikes? Is there any price bounce from the previous day highs and lows? So basically what's that telling you is, let's say you take a sample size of 100, and maybe 70 times, 80 times price goes to previous day highs, and before it breaks previous day highs, it's always bounced like, let's say, 15 pips or 20 pips, and it does that like 70 times out of 100. So that means that's a very high probability trade. Then we know, you know, price. We know the price. What we are looking for is a price spike. We know price spikes up to the previous day highs, and most likely it's gonna not go through the previous day highs or lows. And at the same time, you can really refine your entries at that time. Now let's say in step number 1, we know the pip range. We know during Asian session, price only moves, on average, it moves 30 pips. And then what we see is price is spiking up, and that price spike is already 20 pips or 25 pips to the previous day high. Now we know the range is only 30 pips, and we see a price spike of like 25 pips to the previous day high. What's that telling me is that price is not going to break that high or low. You know, 10 pips far from my entry points, and then just wait for the price to come back to the base of the spike. And we're going to look at some examples, okay? We will look at all the examples. Then you just go to, you know, you just ask yourself like a couple more questions. Phase number 3, news. Is there any news coming out during Asian session? Mostly it's going to be, you know, related to Australia or like New Zealand, Japanese. So you just ask yourself, like if you're trading British pound and US dollar, if there's any major market moving news coming out, does that news change anything? What is the price action looks like before the news? Let's say 10 minutes before the news. Do we see a consolidation, or, you know, what's happening after the news? Do we see like huge price spikes, or you know, it doesn't do anything? So you would just like take another sample size, just say like 100, and then you just do phase 4, phase 5. So when you're going through that process, when you're taking sample sizes, you're collecting data, what you're doing is you're internalizing the information. And over time, what's going to happen is, after taking a sample size of 500, you will already know what the price action is going to do in that session, and then you know which one is a high probability trade and which one is a low probability trade. So let's look at some examples. So we are still studying price behavior during Asian session, which is from 2200 GMT to 500 GMT. Now, based on 500 plus sample sizes that I took, I came up with this. These are all price patterns or price behaviors that I like to trade. So number 1, previous day highs and lows. This one is a very high probability price setup. And then we have price spikes, previous day, intra-week, and we're going to look at that in detail. We have price pop, some other nodes, price sits on important level. Sometimes we see very sharp unexpected spikes. We will see some examples. Some other notes that I made, Tokyo opens around 00 GMT. That's when price 2200 to 00 GMT. Price is very thin because 22 is a rollover. And when price is thin, there's not any liquidity in the market, okay? And when there's no liquidity in the market, if you see a big order comes in, it's going to push the price to one side, okay? Because there's no liquidity. So it's going to push the price to one side, and you might see very sharp, unexpected spike. Maybe, you know, like 70 pip, 80 pips of spike. So what's that telling me is that I always want to control my risk because I don't know what's going to happen in the market. So I don't want to risk too much on a single trade. Then we have London Open. During London Open, they will always reference Asian range, and any other notes like any small spikes during Asian range, they will get filled. So let's look at each step in detail. Okay, there's just actually another example here. This one, again, this is from 2012 when I was going through the process. Phase number 2, I was just studying how the price respond around previous day high and lows. So on this side here, we have week, then we have days, Monday, Tuesday, Wednesday. And then here we have some other notes, yes equal to 1, no, it should be actually 0, that's a typo. So here, you just ask a couple questions to yourself. Does it go within 5 pip of previous day high and low? If yes, then you just write 1, Tuesday, yes, and then how much response from the previous day high and low, what is the spike looks like. When price was spiking to the previous day high, we see a spike of 20 pips, 20 pip. What the price movement looks like, was that as a range bound or inefficient move? So you just ask like a couple questions to yourself, you record everything, then you collect data, then you after a couple of days when you have a sample size of 50 or 100, you go back, you study that data again. So I have already done this, so let's look at some examples now. So here we have previous day's high and lows during Asian session. So on this example, this the day. So on the left side we have previous day, and then on the right side we have Asian session. So on previous day we have previous day highs, okay, and then we have open spike here. See, price spikes higher on the previous day, and then at the end of the day price is just moving sideways, okay. Now during Asian session we see another price spike, so price is spiking higher to the previous day, and this spike could be 10 pips, 15 pips, 20 pips. Now this one is a very high probability trade, so you might want to just make a note of this. So what you're looking for is to trade this price behavior, you're looking for this price spike, okay. So you want to see an open price spike to the previous day high and low or to any key level, and at the same time we have price spikes on this side here, okay. So that means most likely price is not going to break previous day highs or previous day low. So here we see prices moving higher. We're going to take a sell trade here, and your stop that depends on your price spike. We know the Asian range, the average pip range during Asian session is only about 30 pip. So if we see a price spike of 20 pip, I would just put my stop 10 pips above my entry points. And then we take a sell trade here, price comes down to the base of the price, base of this price swing, okay. Then we see another price spike to the previous day's high again, and then we see another price move to the downside to fill this open leg. If you're new to trading, if you don't know, anytime when you see price spike, most likely price gonna come back to the base of the spike to fill that. Let me show you that on a candlestick chart. So basically that's what I had on the other example there. See, we at the end, pretty much at the end of the day, we have this huge price spikes. Looks like a news driven because that's that's around like 1500 GMT. So yeah, looks like news driven. Present the start of the day. Then during Asian session, price spikes up. Okay, so we see this two green candles here. Price spikes up to the previous day high. And so we would take our sell entry here, and we are expecting the price to come back to the base of the spike. So we have price spike here. Okay, so price is spiking higher. We have another price spike here, and then we expect the price to come back to the base of the spike. Okay, and then price takes another entry here, right? Price actually move higher again. You can take another trade here, another sell trade, and then we see price comes down to the consolidation base here. And then we have London open session. So you can see same thing here. Asian session is pretty range bound, very narrow. And London open, we see big price movement. And on this example, I see a very high probability trade set up on London open session. So that setup is anytime when you see price goes out of Asian range. So if you take this line, okay, if you take this line and if you just extend it, that's going to give you Asian range high, okay, the highest point in the Asian range. During London open session, when price spikes out of Asian session, and then most likely it's going to go to the other side of the Asian range. Okay, so we have Asian range here. We have top side of the Asian range. We have bottom side of the Asian range. Price breaks out of the Asian range, comes back in. We are expecting the price to go to the other side of the Asian range. And we see that price behavior repeating on this side as well. Price breaks out of the Asian range, comes back in the Asian range. We are expecting the price to go to the other side of the Asian range. Now at some point the range has to expand, okay? At some point it's going to break out of that range. So don't just take too many trades on this. I would just take one trade on this side here, one trade on this side. After that, I'm not going to take any more trades on this price behavior because I know at some point the range has to expand. Okay. Any questions so far? Yeah, you guys are doing good. Okay. So here we see another example, same price behavior, highs, previous day's highs and lows. Okay, so here we have previous day highs. Then we have Asian session. We see this price spike, which is 20 pip. We see 20 pips of spike. Looks like pretty, it's one direction, pretty inefficient spike to the previous day high. And this is 10-minute candle chart. So we would actually take our sell entry here, and we are expecting the price to come back to the base of the spike. And now that's what it looks like on a 1-minute time frame. So that's what you are looking for. Like when you want to enter in a trade, what you do, you go down to 1-minute time frame, and you're looking for price spikes. So you're looking for this price behavior. So here we see prices spiking higher, and you would have your key level here. Okay, so your previous day high is here, and that's where you would take your sell entry, and you're expecting the price to come back to the base of the spike. Okay, and it does that on all the price pairs. It doesn't on all the currency pairs. It doesn't matter what you're trading, British pound, any currency pair, Aussie Japanese, US Japanese pair, doesn't matter. Price goes up, price comes down to fill that spike. we see same price behavior here. We have a price spike down to fill that price is filling up that open spike. We have open spike, price goes up to fill that open spike. Even on this one here, see this bullish move here. We have open spike, price comes down to fill that open spike. Another open spike, price comes down to fill that open spike. Another open spike, price comes down to fill that. Okay, so price is doing that all the time. Open spike to the downside, price moves higher to fill that spike. Okay, so that's a very, very important price behavior. So we have one question here. Just give me a second. What do you mean 100 sample size? Okay, yeah. So what I mean is, let's say you're studying price behavior. Maybe you're studying how to trade highs and lows. So you would actually let's look at another example here. So what you would do is you're going to open up your charts, okay, and you will mark down previous day high. Let's say you're studying high and lows during Asian session. So you're going to mark down previous day high. So you would draw a line here, okay, and then you will see how price react or respond to the previous day high on this day, okay. So that's your sample one. All right, does that make sense? So you're taking you're engaging with the market 100 times, okay. You're taking sample size of 100 pretty much. So this one is sample one, okay. So because that's a different example, and this one would be sample two because that's a totally different example. So you're basically going through 100 different examples, and you're taking notes. You're just you can take a snapshot of that, just write down some notes. What happened, what the price spike was going into the previous day high and low, what price respond did you see. Like on this example, let's say I would just take a snapshot of this, and I would just mark down my level here, and I would say, okay, we had during Asian session, we had a price spike to the bottom or to the previous day's low. Okay, and I would just write down how big the price spike was. Maybe it's 20, because price is just moving to one direction. And I would also make a note of this open spike here. So we have an open spike to the previous day's low. We have open spike here as well. Okay, so we are expecting the price to fill this open spike. And at the same time, we are expecting the price to fill this open spike. So you study that 100 times, okay, to take a sample size of 100. And when you do that, over time, what's going to happen, you will see which one is a high probability price behavior, which one is a low probability price behavior. So this one, based on my sample sizes, countless sample sizes, I came up with this, and I think it's a very high probability trade. So yeah, so we see a price spike here. You would take your buy entry here. Your stop would go just below the lows here, and you are expecting the price to pull back to the base of the spike. Okay. On this example, it doesn't fill this range here, but it still gives you a lot of room to take your profit. So I would just close 80% of my position here, let maybe 20% run, and you can also move your stop to break even just in case if price takes another leg down, so you don't lose any money on this. Okay. All right. So let's look at some other example. So the next price behavior we have is something I called price pop. So what's that mean is, and we are still doing an Asian session, okay? So you have on the previous day, so this line represents the end of the day. So on previous day, we have a pretty big price spike to the upside. And then at the end of the day, price kind of like it stalls, okay? So we see a sideways movement. And then during Asian session, price takes another leg up, okay? So price is drifting higher, and at some point, price gonna retrace back to fill this open spike here. So we have open spike around this area here. We have open spike around this. Let me just try to change the color. Okay, so let's do red. Okay, so we have open spike here as well. Okay, then I just made some notes here. You know, if you're taking level, maybe this key level is coming from other price behaviors. Maybe it's intra-week, high and low, or you know, any very strong support and resistance level. Yeah, so you would just have a key level here, and then you take your sell entry. You're expecting the price to come back to fill up the open spike. And we see that open spikes like filling up all the times. Even like here, we see open spike to the downside. Price comes up to fill that open spike. Okay, we see a smaller version of the open spike. Price comes down to fill that. We see this open spike. Price comes down to fill that. We see this open spike. Price goes higher to fill that. Another open spike, price moves up. Another open spike, price moves up. Okay, so we see that like everywhere, price goes down, price goes up. Okay, so you always want to look for open spikes before you you know, place any trade. So here we have another price behavior that we watch out for during Asian session. Any open spikes, they get filled. So we already saw a couple examples of that. So here we have open spike, and price fill up that open spike. We have open spike, price fill up the open spike, another open spike, price fill up the open spike, another one here, and price fill that up. Okay, so how do we trade that? You have the open spike going into a key. That's where you would take your sell trade. You're expecting the price to come back to the base of the open spike. Price sits on important level. This one, I wouldn't trade this price behavior, but still, you still want to understand, you know, all the price movements. That way, when you're sitting in front of your charts, you're very comfortable with the price movements, and that's going to come from your sample sizes. Okay, so basically this price behavior is like you have a consolidation based on the previous day. You have some kind of consolidation. Sometimes during Asian session, you're going to just notice price comes down and it's going to just sit on that consolidation. Okay, this one is a low probability trade, so I wouldn't trade it. I would actually look for price to go to the previous here. Okay, but price doesn't get there. Okay, price just sit on this this level here, and then I think price just takes another leg up. Okay, so all right, so this one is important. Sharp move. Okay, so we see unexpected sharp movement here. So what we have Asian session, and I just made a note that 50 pip unexpected spike. There was no news, no major market moving news on Forex factory calendar, and it's a 5-minute candle chart. So we were pretty range bound. Okay, there's not much happening like a normal price behavior that we see during Asian session. You can see here price spikes down, price move higher to fill that spike, right? So we expect that price is moving higher, comes down, move higher. So price is doing its thing, and all of a sudden we see a huge price spike. Okay, how do we trade that? Unfortunately, we don't know what's causing the spike because there was nothing on the Forex factory. Okay, so I wouldn't trade this. Okay, but if this is happening, that's telling me I should not be risking too much money on any single trade. Personally, I like to risk maximum 0.5% on every single trade. Okay, and most of the time, and that's a maximum. Most of the time I'm only risking 0.25%. And yeah, so this one, like if you take a loss on this, you know, your account is down by only 0.25%, which is nothing. So let's look at London open session here. London open session is from 500 GMT to 10:30 GMT, and based on my sample sizes that what I have on my study, I came up with all these price behaviors. Some of them we trade, some of them we don't trade. Okay, so we have high and lows. We have price spikes, Asian gap, very important price behavior, false breakout of Asian range. So we already saw that. News related, big figure, retest of Asian range. So let's look at some of them. So high and lows during London open session. So here we have previous day high and lows during London open session to the previous day lows. And again, you're looking for that open spike here for your entry. That's where you take your buy entry, and we are expecting the price to move higher to fill up the open spike. Same thing, look at this. We have open spike here, we got open spike here. We are expecting the price to pull back in to fill this open spike, and then we are expecting the price to fill this area here, fill this open spike here. Okay. Now this is amazing. So on this side here we have open spike, price comes down to fill that open spike. Alright, so very classic price behavior. Okay, so we got another one here, same thing, London open. This is 20-minute chart, price is price, doesn't matter if you're looking at 5-minute, 10-minute, 20-minute time frame, doesn't matter. We see same thing here, we have previous day highs, and price spikes up to the previous day high. That's what that spike looks like on a 1-minute time frame on the right side here. 1-minute time frame, price spikes up. We are expecting the price to pull back in. Okay. Another price behavior, price spikes on a previous day. If you have an open price spike like this, okay, then on the next day during London open session, you are expecting the price to fill up that spike. It's not going to do that during Asian session because we know Asian session is a range bound. 30 pips or maximum 40 pips, okay? So if you have a huge spike like this, most likely it's going to fill that up during London open session because that's very volatile session. And you will understand that after going through, you know, your study after taking those sample sizes. All right, so we got some other notes here. I'm just going a little bit fast because we have a lot of information to cover. Yeah, so we got some other notes here. Previous day, we see open spike on the previous day. During London open session, we are expecting the price to fill up that open spike. Okay, this one is my favorite price behavior. Okay, very high probability. And you guys can actually start trading this right way. If you want, you know, like on Monday, Tuesday, just like start trading this price behavior. So we have Asian session. We mark down the top side of the Asian session, okay? And then we have bottom side of the Asian session during London Open. If price breaks out of Asian session and then pull back in, most likely it's going to go to the other side of the Asian session. To the other side of the Asian range. Okay, so we have Asian range during London open session, price breaks out and then comes back in. We are expecting the price to go to the other side of the Asian range. And we see same price behavior on this side here. Okay, so I just call it false breakout. So we see price breaks out of Asian session or Asian range, price comes back in, we are expecting the price to go to the other side. Now remember, at some point the range has to expand. At some point it's going to break out of that range. Okay, so I would just trade on this side here one time, on this side here single trade. That's it. After that, no more trades on this price behavior. Okay. Otherwise, you don't want to just buy sell every single time. It's not a good idea. Asian gap, very important price behavior here. Let's say during Asian session, price, we see one-way price movement. Okay, so price, for whatever reason, price is just like moving to one side. In this example, price is just moving higher. During London open session, we're going to expect the price to pull back in the range to fill that open spike. We have open spike. During London open, we are expecting the price to fill that open spike. Price breaks out of the Asian range, comes back in, same price behavior that we saw before. We are expecting the price to go to the other side. Now we have two things. We have open spike, we have false breakout, we take a sell trade, we take our profit on the bottom side. You can do same thing here. This one is another example of false breakout. Price breaks out of the Asian range, comes back in, take a buy, and you're expecting to for the price to go to the other side of the Asian range. Retest of Asian range, that's another one I like. So as I said, at some point during London open session, price going to break out of the Asian range. And then we expect the price to come back to the Asian range to the bottom side, and we take our sell entry there. So for example, this is Asian range. Price breaks out of the Asian range, price drift sideways, and price comes back up. You would take your sell entry here, okay? And price would just, we are hoping the price would just take another leg down. This one to me, okay, so this one, I would consider this one as a low probability trade because I don't see any open spike here. This is too small. There's not enough room to take any profit. I like this spike here. See how price spikes up? And I have a note that it says 26 pips. Okay, so we have 26 pip. That's what that spike looks like on a 1 minute time frame. We got open spike, 26 pip. We're going to take our sell entry here. Your stop would be maybe around 10 pips above your entry point. And we are expecting the price to pull back to the base of the spike. That's going to give you more than 2 to 1 reward to risk ratio. Okay, here we have another example of that same price behavior. Price breaks out of the Asian range, okay. Price comes back to test the top side of the Asian range. We have open spike, okay. Price of the Asian range, we take our buy entry here, and price move higher to fill that open spike, okay. Wide Asian range, one of my other one, this one I like it, very high probability trade here. We have pretty big open spike during during Asian session, and for whatever reason, as I said, for whatever reason, we don't know, maybe there, on this one actually it looks like there was a major market moving news that came out. If you look at the price behavior, this one is a 20-minute candle chart. We have price spike up, spike down, spike up, so price is doing its thing, normal price behavior. Then all of a sudden, price stalls, okay, we see price doesn't do anything for 20 minutes. So this candlestick and this candlestick, it's a 10-minute, each bar is 10 minutes. So for 20 minutes, price sits on a very tight range, doesn't do anything. Then all of a sudden we see a huge spike, okay? That means this is a news-driven spike. Price was waiting on something, okay? So how do we trade that? During London open session, we're gonna wait for the price to go to the highest point here, to the top side of the Asian range or to the bottom side of the Asian range. And let's say instead of, in this case, price, this is not tradable because price just continue to drift lower. But let's say during London open session, if we see price spikes up, we're going to take our sell entry because we still have open spike here, right? We got this open spike, we got this open spike, we would expect the price to pull back in, okay? So that's how you trade these price behaviors. Then we have London lunch. So these are all the price behaviors that I like to trade during London lunch session. London lunch again, it's one of my favorite session because we know all the big players in the market, they are out for lunch. And if I see price spiking up to any key level, there's not enough strength. It's not, most likely it's not going to break my key level, okay? Because I know all the big players are not trading right now, and so there's nothing big that's pushing the market. So overlap session, the most busiest for this British pound. This is from 1200 GMT to 1530 GMT. All the price behaviors here that I like to trade during this session. We won't be able to cover everything in this 1 hour webinar, but what I will do is, if you guys want to join my next webinar, we will look at in each webinar what we're going to do. We're going to look at one price behavior and we're going to study that in detail, okay? We're going to learn everything about that price behavior with a lot of examples. When to get in, when to get out, how much to risk, what are we expecting, what are we looking for before we get in the trade. So pretty much everything. So one thing at a time, okay? So London close, so all the price behavior here. Then we have New York close, which is from 1700 to 2200 GMT. New York close, I don't like to trade after 1800 GMT, okay? I still like to observe price. I want to know what price is doing so I can internalize that information, but I wouldn't trade my live account after 1800 GMT. The reason for that is because that's when the market is very thin. There's no liquidity in the market. If something comes in, maybe there's FOMC or Fed, Fed speech, something like that, it's going to push the price to one side. It's going to blow all your technical levels. Doesn't matter how strong your level is. Doesn't matter if it's your level is coming from 1 hour time frame, 4 hour daily time frame. It's going to blow through that level. So for that reason, I don't like to trade it. Okay, but sometimes you still want to just observe those price behavior. You're still refining everything. You still want to see which one is a high probability, low probability. So yeah. Okay, any questions so far? All right, so if you like to learn more about every session, and I am releasing a course on every session actually in the next few days. The price is $1, and in the training program, basically I'm gonna show you every price behavior in detail. I will show you the back testing examples. I will show you the live trading examples, and so pretty much everything. How to place a trade, how do you take your profit, what your your levels are. So everything. So each session, let's say maybe you work during a day, right? So you have a 9-to-5 job. So that means maybe you want to trade Asian session, okay? So you can buy this one, or maybe you like to trade before you go for your full-time job. So you might want to go with maybe London lunch. You only trade for 2 hours, and London lunch, as I said, that's my favorite time to trade. It's going to give you very high probability trades. Yeah, so that one is a good one. London close, that's if you can trade that, that's perfect. You can also buy everything for $497. Yes, if you're interested, send me an email. Send an email to info@burmifxtrading.com, and then I will provide all the information to you. Guys, I'm also doing a live workshop, so I'm coming to Toronto, Edmonton, Calgary, and Vancouver. The workshop, it's a one-day live event for pretty much a full day. So we're gonna start the event at 600 GMT, so 6 GMT, and then we finish at 17 GMT. So pretty much that's when London is open and at New York or London close. Okay. So yeah, so what we are doing in the live workshop is I will be trading a demo account. I will be like trading a live market, but with a demo account. Okay, so we're gonna trading. I will show you like how I set up my charts and how I get in the trades, how I control my risk, how I control my losing trades. So everything. So the online course is $497, but if you register for the live workshop, which is $997, and the workshop actually includes my online course. Okay, so it's like you're only paying $500 to come to the workshop. And I also offer one-on-one live trading for 7 days. That's 5,000. So any questions? So we see another question here. Best broker. Best broker. I like to trade with IC markets. To me, you know, they're pretty good. I like their sport and everything. The broker, you want to find where you're not just paying for the spread. Okay, your broker should be like commission-based broker. Okay, not any other broker where the spread is like 3 pips or 4 pips. If you go with IC markets, for example, their spreads are very tight. The spread is only like, sometimes the spread is 0. Like, you know, like it's only 0.1, 0.5. Yeah, so their spreads are great. Their customer service great. Anytime you have question, just you know, you just go to their website and chat with them. So to me, I am very happy with IC markets. I used to be with Oanda long time ago, but as I said, like Oanda is their spreads are quite high if you compare to the IC markets. IC markets, they will charge you commission. Okay, so the difference is, let's say the reason, like, yes, that's a very good question. The reason why you want to trade with a commission based broker is, the reason is, let me show you an example. Let me just find an example for you. Okay, let's look at this one here. So let's look at this area here. Okay, so let's say you are with you know, IC markets. So what you do, you're trading this price behavior. Okay, it's a false breakout or Asian gap. So you're trading this price behavior. So price comes back in the Asian range during London open session. You would take your buy trade here. Okay. Now, if you're with IC market, most likely when price comes back, okay, see this price spike here? It's pulling back in. It all entry point here. Okay. If your spread is tight, if your spread is only 0.5 pip, it's not going to stop you out. But on the other side, if your spreads are like 3 pip, 4 pip, when the price comes back for a retest like this, most likely it's going to stop you out if you move your stop loss to break even. Okay. So on this example here, what I would do is I would take my trade here. Just give me a second. So I would just take my buy trade here, and I'm going to close most of my position here, about like, let's say 70%. And then on the remaining position, I'm going break even. If price comes back for a retest, okay, most likely it's not gonna stop me out, okay, because the price was still, my entry was still about a pip far from the price, okay. So it's not going to stop me out there. Yeah, so that's a difference. So that's why you want to find a broker that's a commission based, not a spread. Okay. Any other questions? Yes. Yeah. So yeah, that's right. Yeah. So send me if you send me an email on that at info at Burmi FX Trading. So I will send you a link on how to register for the live workshop. Okay. And yeah, you're getting the program free with the live workshop. Any other questions? Anything that you guys did not understand? When do I trade? I'm a full-time trader, so most of the time I'm trading pretty much all the sessions. I'm observing everything all the time, and if I see a high probability trade coming up, then I would trade it. Yeah, but most of the time, I like to trade London close and overlap session. Yes, definitely I'm trading those two sessions every day. Yeah, definitely. London Open, sometimes I miss it, but I like to trade London Open, but we have another question here. IC Markets in Canada office. They are located, they are in Australia, okay. So their head office is in Australia, but they are regulated, okay. So they are not scam. They are regulated by Australian, yeah, Australian office here. Okay. Any other question? Yeah, the next webinar I will email you the link. It's going to be on the high and lows. Okay, so we will look at how to trade daily high and lows. Okay, so this webinar was just it was more like an introduction. We look at the process in this webinar. So we are covering how to master everything. Okay, so I have given you a process, and you can take that process, apply that to any other currency pair. All right, so yeah, definitely, yes, definitely it's going to take time to go through those sample sizes. But that's how you will actually refine everything. It's just showing you something. You don't know if that works or not. Okay, you need you need a good study. Okay, when you take a sample size of like 100, 500, you know how many times that price behavior works, how many times it doesn't work. Even like when it works, then you further refine that to see how many times it's gonna give me 2-to-1 reward to risk ratio, how many times it's going to give me 1-to-1 reward to risk ratio. Yeah, so you would look at all that. You don't have to. The purpose of this webinar is to speed up your learning process. So I have already gone through all the information. You can just take my bullet points, what I have, by those programs, and that's going to definitely speed up everything for you. All right, yeah, all right, guys. So any other question before we call it a wrap? Okay. All right, yeah, so that's it. I will see you guys next time. Thank you for joining this webinar.